Welcome to our deep dive, exploring the ideas of two investing giants, Charlie Munger and Warren Buffett.
It should be a fascinating exploration.
We're using a book about Munger, some of his best quotes, and a look at how Berkshire Hathaway does things.
Right.
Finance can sound dry, but we'll uncover the human side of investing.
It's all about psychology, good decisions, and even a bit of philosophy.
Let's start with this story from our material, about a tightrope walker. Why is it relevant to investing?
Well, a tightrope walker survives by knowing their limits, right?
I suppose.
Munger ties this to investing. He says it's about having a circle of competence. Basically, you need to know what you truly understand and stay within those limits.
So, like, if I know healthcare, I shouldn't invest in complex biotech startups.
Exactly. Munger says knowing what you don't know is just as important as what you do know.
Makes sense. Now, what about this question? Index funds or actively picking stocks?
Ah, the age-old debate.
Munger recommends index funds for know-nothing investors.
Right. He does. But he's not being rude. He means folks who haven't learned the basics of investing. Index funds are simple, low fees.
So they're good for hands-off investors.
They are, but they usually just match the market's performance. Active picking can do better, but it takes real skill and effort.
It's not for beginners, then.
Definitely not. You know, this reminds me of a story from our material about an investor, a talking frog, and a magic spell.
Sounds strange. What's the connection to investing?
Well, this investor finds a talking frog. The frog says he's a stock speculator trapped by a spell. The frog begs for a kiss to break the spell, promises riches. But the investor keeps the frog. He says, "You're more valuable as a talking frog."
Interesting.
It shows the difference between investing and speculating. The investor sees long-term value like owning a unique asset.
So the investor's thinking long-term, but the speculator is all about the quick profit.
Right. Munger and Buffett say true investors care about intrinsic value, the actual worth of something. Speculators chase trends, trying to buy low, sell high. Like that frog, they want the fast money.
Makes sense. Speaking of good decisions, let's talk about risk. There's a story about an oil prospector in heaven.
Oh, the one who hears there's no more room in heaven's oil section.
That's it.
So he shouts to those inside, "Oil's been found in hell!" Everyone rushes out. He thinks maybe there's something to that rumor after all.
Pretty funny. But what's the link to investing?
It shows us following the crowd, even when it's crazy, like the fear of missing out.
Like when everyone's buying a certain stock, so you feel you have to as well?
Exactly. Buffett defines risk as not knowing what you're doing. He tells a story about a gathering, Bishop's Lodge in Santa Fe, worried about security for millions in jewels.
Mule's just lying around.
Apparently. The guy in charge, Ike Friedman, shows Buffett the safe, the guards, then says, "The jewels aren't in the safe, by the way." Buffett's point is, real risk is about what we don't realize, thinking we're safe when we're not, like assuming the jewels were protected just because there was a safe.
So the real risk wasn't theft, but that false sense of security.
Right. And that leads us to another Munger concept, the Lollapalooza effect.
Sounds interesting.
It's when a bunch of psychological biases all work together.
Okay.
They amplify each other and make us do crazy things. Think of an open outcry auction, the bidding frenzy.
People get caught up in the moment.
They do. The bids make you think the item must be valuable social proof. Then, the auctioneer's good at making you feel obligated to bid.
Reciprocity.
Exactly. Plus, you don't want to miss out.
So you overpay.
Often. The Lollapalooza effect happens everywhere, not just auctions. Tupperware parties, the rise of Coca-Cola, they all used it.
We need to understand this effect then.
We do. Whether we're investing or just buying stuff, it helps us make smarter choices. Now, Munger also talks about a lattice work of mental models. What do you think that means?
Sounds complicated.
It just means using ideas from different fields to understand the world, not just one way of thinking, like economics.
So like looking at a problem from multiple angles.
Yes. Imagine price increases. Economics says it's supply and demand, but psychology might say people think higher price means higher quality.
I see that.
And sociology might say it's bribery, suppliers paying off buyers.
Wow, so many ways to look at the same thing.
Right. Using multiple models gives us a better picture.
This reminds me of Munger's quote about an investment manager who bragged about 20% returns.
Oh, right. He was hiding the risky stuff he did to get those returns.
Exactly. It's like Munger's iron rule of nature. Like you get what you reward for.
Exactly. We need to look at the whole picture, not just the outcome. Think of Roman architects. They stood under their arches as the scaffolding was removed.
Bold move.
Right. But it meant they were incentivized to build well. Their life depended on it. Munger wants systems that reward good behavior, not just quick wins.
So let's move from theory to practice. What makes the Berkshire system unique?
It builds on classic value investing, but adds its own twist.
Like what?
Well, four main things. First, they're amazing at using taxes to their advantage.
Yeah.
Like, they can move money between subsidiaries without a big tax hit, say from seize candies to fund growth somewhere else.
Smart. What's the second thing?
Decentralized management. They trust the CEOs of their companies to run things well.
Doesn't that seem risky?
But they keep control over the big decisions. How money's spent, executive pay, it's balance, freedom, and guidance together.
What's the third thing?
They're the private buyer of first resort, meaning they offer business owners a great deal. Sell to Berkshire, your company thrives, your legacy continues.
That sounds appealing.
It is. Gets them quality companies at good prices. And finally, they have permanent capital.
What does that mean?
They're not pressured to make quick profits like publicly traded companies. They can hold investments for years, even decades.
Wow, that's a big advantage.
Huge. They can ride out market dips, wait for long-term growth.
Now let's talk about moats, those protective barriers that give companies an edge.
Munger and Buffett love moats. They say buy companies with them, don't try to build them yourself. Takes too long.
Like buying a castle instead of constructing one.
Exactly. Moats come in different forms, like economies of scale, bigger is better.
Right, think Amazon's warehouses.
Yes. Imagine a giant tank. The volume grows faster than the surface area as you make it bigger. Same with business. Cost per unit goes down as you produce more. That's supply side.
Okay, I see.
Then there's demand side economies of scale network effects. The more users, the more valuable the platform is, like Facebook or eBay.
The more people use it, the more attractive it is to others.
Right. Brand power is another moat. These candies, Disney, people pay more for their brand, even if competitors are cheaper.
So you're buying the reputation. What about regulation? Can that be a moat?
It can. Highly regulated industries like pharmaceuticals or banking are hard to enter.
So the rules actually protect the existing companies.
Sometimes, yes. Then we have intellectual property. Patents, trademarks, copyrights, exclusive rights to your invention or creative work.
Like a temporary monopoly, right?
Basically, so many types of moats. Understanding them helps us pick the right companies to invest in.
Great insights on moats. Now let's end this section with the story of an investment banker and a carpenter on a plane.
Classic tale.
That's the lesson there.
The investment banker, feeling smart, offers a bet to the carpenter. He asks a question. If the carpenter gets it right, he wins $500, but if he gets it wrong, he pays $5.
Sounds risky for the banker.
He's overconfident. He asks, how far is Earth from Saturn? The carpenter, knowing he doesn't know, pays the $5.
A smart move.
Then it's the carpenter's turn. He asks, what goes up a hill with 3 legs and comes down with 4?
I didn't know that one.
The banker spends hours trying to figure it out, emails his friends, no luck. Finally gives up and pays the $500.
So what was the answer?
A human. Crawls on all fours as a baby, walks on 2 legs as an adult, and often uses a cane in old age.
I see.
Simple, but clever. And it's a perfect illustration of Munger and Buffett's love of simplicity.
They like businesses they understand.
They do. They avoid complexity because it can hide problems. Like Munger said, where you have complexity, you can have fraud and mistakes.
So stick to what you know. Keep it simple. Good advice.
Absolutely.
That was an interesting look at the value of simplicity. Now, what sets the Berkshire system apart? What makes it so unique?
Well, they have this system built on 4 key pillars. Each one plays a big role in their success.
All right, I'm intrigued. Let's break down those pillars. What's the first one?
Tax efficiency. They're incredibly good at maneuvering within the tax code. Their structure allows them to move money between subsidiaries without getting slammed with huge taxes.
Can you give an example?
Sure. Let's say See's Candies is making a lot of profit. They can use that to invest in another area of the business without having to pay a ton in taxes if See's Candies were to pay dividends directly to shareholders.
Clever. What's the second pillar?
Decentralized management. They give the CEOs of their companies a ton of freedom to run things.
Wow, that seems like a lot of trust. Are they worried about things going off track?
Well, they balance it out. They still control the big things like how capital is allocated and executive compensation. So there's a mix of freedom and guidance.
Okay, that makes sense. What's the third pillar?
They call themselves the private buyer of first resort. They offer a great deal to business owners looking to sell.
What kind of deal?
They can sell to Berkshire, and the company can keep thriving. It's a way to protect their legacy.
So it's a win-win.
Exactly. It attracts high-quality companies and lets Berkshire get good deals. The fourth pillar is permanent capital.
Permanent capital, what's that?
They're not under pressure to produce quick profits like a lot of publicly traded companies are.
Oh, I see. They can be more patient.
Right. They don't have to worry about quarterly earnings reports or the stock market going up and down. They can hold investments for years, even decades.
That must give them a huge advantage.
Absolutely. It lets them ride out market fluctuations and wait for long-term growth. Okay, let's move on to Munger's idea of building a latticework of mental models. What do you make of that?
To be honest, it sounds a bit academic to me. Can you explain it in simpler terms?
Sure. It basically means using knowledge from lots of different fields to understand the world better, not just relying on one way of thinking like just economics.
So it's about looking at problems from different angles.
Exactly. Think about something like price increases. Economics says it's all about supply and demand. But psychology might say that people think higher prices mean better quality.
You're right. People often associate price with quality.
And then sociology might even point to things like bribery. Suppliers giving kickbacks to buyers to choose their products.
That's a whole different perspective.
It is. So you see, using these different models gives us a much richer understanding.
Makes sense. This reminds me of that quote from Munger about the investment manager who boasted about achieving 20% returns.
You mean the one where he was hiding all the risky moves he made to get those returns?
That's the one. It goes back to Munger's iron rule of nature, right?
Yeah.
You get what you reward for.
Exactly. We can't just focus on the outcome. We have to look at how that outcome was achieved. Think of those Roman architects. They stood under their arches when they removed the scaffolding.
That's a pretty bold statement of confidence.
Right. But it also meant they were strongly incentivized to build those arches well. Their life depended on it. Munger argues we should build systems that reward ethical behavior, not just quick results.
Okay, that's a powerful image. Let's shift gears and talk about the Lollapalooza effect.
Ah, yes, the Lollapalooza effect.
What is it exactly, and how does it influence our decisions?
It's basically a situation where several psychological biases all combine.
Okay.
They work together, amplifying each other, and often leading to irrational choices. A good example is the frenzy of an open outcry auction.
It's true. People get really caught up in the bidding.
Right. The fast-paced bidding, the auctioneer's skill at persuasion, the fear of missing out, all of that combines to create a kind of psychological pressure cooker. It can make people bid way more than they normally would.
It's like a social contagion almost. Everyone's getting swept up in the excitement.
Exactly. And it's not just auctions. Think about Tupperware parties, or even the way Coca-Cola rose to dominance. They all tapped into this Lollapalooza effect.
So this effect is all around us, influencing our decisions in subtle ways.
It is, and it's not always a bad thing. It can be used for positive purposes as well, but being aware of it helps us make smarter choices, whether we're investing or simply buying things.
Good point. Now let's talk about the difference between being an investor and being a speculator. What's the key distinction?
It comes down to mindset and approach. True investors, like Munger and Buffett, focus on the inherent value of an asset. They carefully assess a company's worth based on its fundamentals and long-term potential.
So they're looking for companies with strong foundations and a track record of good management.
Exactly. They view their investments as partnerships. They align themselves with businesses they believe in and are willing to hold on to those investments for the long haul. Speculators, on the other hand, are driven by short-term profits.
So speculators are more interested in trying to time the market and ride the waves of price fluctuation.
Right. They try to predict market trends and profit from short-term swings. They're less concerned with the underlying value of an asset and more focused on making a quick buck.
Okay, that makes sense. Now, what about risk? How do Munger and Buffett approach risk differently from traditional investors?
They challenge the conventional view of risk as simply volatility. For them, true risk comes from not understanding what you're doing.
So it's not about the possibility of losing money, but rather the lack of knowledge or understanding that amplifies those risks.
Precisely. They emphasize staying within your circle of competence. That means investing in areas where you have expertise and can confidently assess the risks involved.
So don't venture outside of your area of expertise.
Right. It's like a surgeon refusing to perform a heart transplant because their specialty is brain surgery. It's about knowing your limits and not taking unnecessary risks.
That brings us back to the story about the missing jewels at Bishop's Lodge.
Ah, yes. The jewels weren't in the safe.
Exactly. It showed how perceived security can actually create a false sense of safety and hide the real risks.
That story illustrates their point perfectly. Buffett wasn't worried about the lack of guards or alarms. He was concerned about the illusion of security they created. The real risk was assuming the jewels were protected because they were in a safe place.
So the real danger was the lack of awareness, the assumption that everything was fine.
Right, and that applies to investing and life in general. We need to be aware of our blind spots and not be lulled into a false sense of security.
Now let's touch on the concept of recognizing what you don't know. How does that play into Munger and Buffett's approach?
They view acknowledging limitations as a strength, not a weakness. They know they can't be experts in everything. They recognize that trying to invest in areas outside their expertise is a recipe for disaster.
So it's about being honest with yourself about what you know and what you don't know.
Exactly. They define their circle of competence and stick to it. That helps them avoid making rash decisions based on incomplete information. It's a disciplined approach.
So if you're not comfortable with a particular investment or industry, don't be afraid to walk away.
Exactly. There are always other opportunities. Better to wait for something you understand than to jump into something you don't.
That leads to the question many investors face. Should they choose index funds or actively pick stocks?
It's a debate that never seems to end. Munger famously said that index funds are suitable for know-nothing investors. Which sounds kind of harsh, right?
Yeah, a little bit.
But he wasn't trying to be insulting. He meant that for people who haven't taken the time to learn the ins and outs of investing, index funds are a reasonable choice.
So they're good for people who want a simple, hands-off approach.
Exactly. They offer diversification, low fees, and they tend to perform in line with the overall market.
It's a good starting point for beginners.
It is. Now, for those who want to actively pick stocks, it's a different game. You need a deeper understanding of financial statements, valuation methods, and all the other complexities of the market.
So it's not something to jump into lightly.
Definitely not. Successful stock pickers are meticulous researchers. They spend countless hours poring over data, looking for those undervalued gems that have the potential for big growth.
So it's not about chasing the latest fads or trying to time the market.
Nope. It's about doing your homework and finding companies with strong fundamentals that are poised for long-term success.
This brings to mind the story about the investor who stumbled upon a talking frog.
Oh, you mean the one who claimed to be a stock speculator trapped under a magic spell?
That's the one. What was the lesson there?
It highlights the fundamental difference between investing and speculating. The investor, recognizing the unique value of a talking frog, chose to keep it. They saw the long-term entertainment potential. A speculator, on the other hand, would probably try to sell the talking frog to the highest bidder.
So it's about recognizing true value versus chasing after a quick buck.
Exactly. Investors, like the person in the story, focus on intrinsic worth. They look for assets with long-term potential. Speculators are driven by short-term gains and are often willing to take bigger risks for a quick profit.
So the lesson is to be patient and focus on the fundamentals, rather than trying to get rich quick.
That's a good way to put it. Now let's delve into the concept of moats, those protective barriers that give companies a competitive advantage.
I'm intrigued. What are the key characteristics of a robust moat?
Well, think of a moat as a defensive barrier protecting a company from its competitors. It helps them safeguard their profits and market share.
So it's not just about finding a good business. It's about finding a good business with a durable competitive advantage, something that will protect them in the long run.
Right. Moats come in various forms. One common type is economies of scale.
The idea that bigger is better.
Sometimes, yes. Think of Amazon's vast network of warehouses or Walmart's purchasing power. Their size allows them to operate more efficiently than smaller competitors. They can offer lower prices, wider selections, and faster delivery.
It makes it hard for smaller companies to keep up.
It does. That's the supply side advantage of economies of scale. Then there's a demand side, network effects. The value of a product or service grows as more people use it. Take Facebook and eBay, for example.
The more people who use them, the more valuable they become.
Exactly. That makes it tough for new competitors to break in. Another type of moat is brand power. Companies like Apple or Coca-Cola can charge higher prices because people trust and prefer their brands.
It's the power of recognition and reputation.
Right. They've built up strong brands over time, and people are often willing to pay a premium for that familiarity and trust. Now, this might seem odd, but regulation can also be a moat.
How so?
Well, think about industries like pharmaceuticals or banking. They're heavily regulated. It can be difficult for new companies to enter those markets because they have to jump through so many hoops.
So the regulations create a barrier to entry.
In a way, yes. It can make it hard for new players to compete with the established firms. Finally, we have intellectual property. Things like patents, trademarks, and copyrights.
Those are legal protections for inventions and creative works.
Exactly. They give companies exclusive rights to their products or ideas, giving them a competitive edge.
So they have a limited monopoly.
In essence, yes. Understanding the different types of moats is crucial for investors. It can help you identify companies with a durable advantage that will protect their profitability in the long run.
That's really insightful. Now let's finish up with that story about the investment banker and the carpenter on a plane.
Ah, yes, a classic tale of simplicity and humility.
Remind us what the lesson was there.
Well, the investment banker, feeling rather clever, offered the carpenter a bet. He said, "I'll ask you a question. If you answer correctly, I'll pay you $500. If you're wrong, you pay me $5.
A little condescending, don't you think?
Maybe a bit. But the banker was confident in his superior intellect. He asked, "How far is the Earth from Saturn?"
A tough question,
Yeah,
especially for someone who's not an astronomer.
Right. The carpenter, realizing he didn't know the answer, simply handed the banker $5. Then the carpenter said, "Okay, my turn. What goes up a hill with 3 legs and comes down with 4?"
That's a tricky one.
The banker was stumped. He spent hours racking his brain, even emailing his friends, but he couldn't find the answer. Finally, he gave up and paid the carpenter $500.
So what was the answer?
It's a human. A baby crawls on all fours, an adult walks on 2 legs, and an old person often uses a cane for support.
Ah, of course. Simple, yet profound.
Exactly. And it perfectly illustrates Munger and Buffett's fondness for simplicity. They prefer businesses they can understand easily.
They're not afraid to admit what they don't know?
Not at all. They see complexity as a potential source of problems. As Munger said, where you have complexity, you can have fraud and mistakes.
So stick to what you know. Keep it simple.
Wise words to live by, both in investing and in life.
All right, let's get to those 10 key takeaways we promised. A summary of Munger and Buffett's wisdom.
Ready to distill those insights?
Absolutely. Starting with number 1, what's the most important thing to remember?
Knowing what you don't know is powerful. Find your circle of competence, that area where you have expertise. Stick to it. Don't stray outside those boundaries.
So recognizing our limits is key. What's number 2?
The index funds versus stock picking debate. Index funds are good if you haven't mastered investing or lack time for research.
Simple and less risky, right?
Right. Diversification, low fees, they generally follow the market's performance. Solid for long-term growth.
What about those who DO want to pick stocks? What's takeaway number 3?
Know the difference. Investor versus speculator. Investors like Munger and Buffett look at inherent value. They find solid companies with long-term potential.
While speculators are more about the short game.
Exactly. Trying to time the market, profit from swings, investors are in it for the long haul.
Patience is key. What's number 4?
Risk isn't just about volatility. It's about not understanding what you're doing.
So knowledge protects us from risk.
It does. Stay within your expertise, invest in what you understand, do your research. That's how you minimize risk.
Makes sense. What's takeaway number 5?
Remember the Lollapalooza effect. All those biases working together can lead us to do crazy things.
Like at an auction.
Exactly. We have to recognize these biases in investing and in life.
So we don't get swept away by them. What's number 6?
Munger's lattice work of mental models. Don't limit yourself to one way of thinking.
Right. Use ideas from different fields to get a fuller picture.
Exactly. Psychology, history, sociology, they all offer insights.
What's number 7?
Align incentives. Make sure the rewards encourage the behavior you want.
You get what you reward for, right?
Precisely. This applies to business, personal life, everything. Think about how those Roman architects had skin in the game, literally, with their arches.
What's the 8th takeaway, focusing on the Berkshire system?
They are masters of tax efficiency. They structure things to minimize their tax burden.
So they keep more of their profits to reinvest.
Exactly. What's number 9?
Their unique management style.
Right. Decentralized, they trust their CEOs, but they also maintain control over the big stuff, capital allocation, and executive pay.
Freedom and guidance. It's a good balance. What's our 10th and final takeaway?
Embrace simplicity. Look for clarity and transparency. Don't get bogged down in complexity. Remember that story about the investment banker and the carpenter?
The one with the riddle.
It shows that sometimes the simplest things are the most profound. Munger and Buffett love straightforward businesses they can understand.
They avoid unnecessary complexity. So stick to what you know. Keep it simple.
Yeah.
Excellent advice. That wraps up our 10 key takeaways from Charlie Munger and Warren Buffett.
They offer so much wisdom, not just about investing, but about life in general.
Thanks for joining us on this deep dive. We hope you found it valuable.
And remember, keep learning, keep questioning, and keep investing in your knowledge.
Until next time.